Hey, good morning, everybody. Marty Mazura here, July 28, 2019. I'm going to spend just a few minutes with you on the charts. And I want to start by emphasizing something that I said in this week's weekly message, which I think was an important message given the GDP number and our view of the state of the market. So if you haven't had a chance to read that, please do. It was subtitled The Only Game in Town. I said that it is my observation in this paragraph that via the technicals or the charts, the market's a bit heavy at these levels. Now, I want to show you what I normally show you, then I want to drill down just a little deeper with a few additional charts. I also want to talk about just my overall point here in this paragraph. And this has definitely been my observation that the stock market has a major impact on consumer confidence. In fact, you can put the charts together and you would see what I mean. Um, and I think it does speak to the strong consumer spending numbers, as I said here, and positive attitudes and so on that are showing up in the surveys. Of course, people are working. The jobs market is very strong and people are doing well. They see the market go up, the stock market, and they know they have a job. Everything just feels very good. And I'm not saying that it shouldn't, but I do believe that we need to take note of the conditions under which the consumer feels so good, and of course, the conditions under which the stock market is at all-time highs. Now, so in the GDP number, it really confirmed what we've been seeing week after week in our own macro index, and that is that the consumer is strong, therefore the services sector is strong, but the industrial sector is not. The industrial sector globally is, in fact, rolling over. If you look at the global purchasing managers indexes in many parts of the world, the manufacturing space is contracting. In the US, it's just growing much slower than it has in the past. Now, some would like to argue that, well, we're a services economy, and I agree with that, and I've made that argument myself in the past. But if you chart it and you look back historically, you realize that manufacturing is absolutely and unequivocally a leading economic indicator if you look at it in the aggregate. And right now, it's flashing red lights that I think we should pay very close attention to. Okay, so back to the chart. Here's the one that you are very familiar with. This is the S&P 500 daily chart. We are still in an upward sloping wedge, and as I've talked about here, those almost always resolve to the downside. In fact, I had to adjust a little bit. Here's the wedge we were in previously. We did break below, but we're fighting right back up along this new, very defined trend line. Still keeps us in an upward sloping wedge and looking to maybe regain this one as well. So price action looks fine. I mean, we keep breaking down below these short-term wedges and then finding our legs again and moving right back up into a new pattern, although it is still a pattern that we look to resolve ultimately lower. Now, looking at on balance volume, we have a new look. We actually have a higher high, and I've been saying that we really can't have much faith in what's going on up here amid lower highs in unbalanced volume. That says the conviction has been on the side of the bears. So that is positive. You might say if that continues and this breaks higher and this breaks out of this wedge, that you can say this is real confirmation that stocks are being accumulated. However, this is also moving into its own upward sloping wedge, which is a bearish pattern no matter where you place it. So we would expect this to break down below as well. But we'll take good news where we can get it. Right now, this is positive in terms of volume. As for our momentum indicators, very much in a negative divergence here. In fact, on a short-term basis, we have this nice move higher, but we have a sell signal right here, and then we have a negative short-term divergence. So that is anything but bullish when we look at momentum using the MACD or the moving average convergence divergence. As for the RSI or the relative strength index, same thing. Bearish divergence, really negative divergence right here on a short-term basis. So folks, this would suggest that we should not pay too much attention or not take too much stock in last week's rally. We do have the Fed meeting coming up, of course. We have a lot more earnings coming out, and they've been good on the bottom line, not so good on the top line, meaning earnings have been good, lots of beats, revenue, not so much. And we do want to see better top line growth or revenue growth, because those are the numbers, of course, that companies are least able to manipulate. Okay, so I said I wanted to dig a little deeper and show you a few more charts. This one is also on volume, and this does not paint the rosy picture that on balance volume is beginning to paint. So these gray bars, these are the daily volume figures. And so Friday I've got kind of covered up with my circle here, a little less than 500 million shares for the S&P 500. And you can see it's not high volume, it's average or below average volume. Again, when you see a big move, you want to see big volume, and that denotes conviction. Now, because on a day-to-day basis, any high frequency, data is going to be noisy, you smooth them out with the moving averages. So this is the 10-day exponential moving average of the daily volume. So I want to point something out to you here, and that is that volume has really been waning on a trend basis. And when it gets below that 500 million, you see the gap here, you see a smaller gap here, you see virtually the same gap back here, and we have a gap back here as well before the 10% dip in early 2018. And you can see we touched on just about a gap. Can't see any daylight there, but you could virtually say there's a gap there as well. So recent history, when volume has waned as the market has been high, it has been a precursor for either a moderate to a substantial sell-off. You see here, again, this is the same look we have as we move into new highs here with virtually the same pattern. You can see the gap forming there, and we had what amounted to a 20% correction in stocks. Here we had what amounted to about a 7% correction in May. Back here we have what amounted to a 10, just a little over a 10% correction. And we really haven't had, almost in here, we really haven't had anything like that other than these three spots where ultimately they were followed by pretty noticeable declines, kind of a small one there. Back in here though, you can see that even after the dip, the market rallied very strong for about a month before it ultimately rolled over. So if you want to, you can call that one a false signal. But indeed, in relatively near future, notwithstanding the big boost we got before the rolling over, we did end up with a 10% correction. So this would definitely be in your red flag category as it relates to the sustainability of the current rally. So again, you're getting a feel for why I said the market's feeling heavy to me. Let me give you a little more of my justification for that. So each week when we score the PWA macro index, and I'm working on that this morning, I track what I call the VIX curve. So what the VIX is, or the volatility index, is it tracks implied volatility on at-the-money options on the S&P 500. The green line here is the spot VIX. Then I'm using the 1, 2, 3, 4, 5, 6, and again, that's why I call it the VIX curve. What I noticed this morning is just this huge gap between the spot VIX and the rest, or certainly between the spot and the 1-month VIX. So when you go, and here we are at all-time highs. Look at the gap as it widened right before that last 7% correction that we had in here. Look at how wide the gap got. It's looking familiar before that 20% dip back in here. And then right back in here again, a couple weeks or so before the 10% sell-off in January of 2018, we had a pretty wide gap. Now, couldn't ignore these. You can see this one here rivals what we're looking at. And we really didn't have much. We just had a little bit of maybe a 2 or 3% sell-off right in there that maybe the market or options traders were anticipating. And back in here we got close. Nothing really to speak of. This may have just been kind of setting the stage for this here as option traders were getting worried about these levels and so on. But nonetheless, something to pay attention to. So looking at this and saying maybe this is meaningful, I decided to go ahead and create another graph capturing just the spread between the spot VIX and the 1-month VIX. So that's what this is. So this is just a spread chart or a spread graph. Drew a line right here at 2. So when the spread between the spot VIX and the 1-month VIX exceeds 2, it's going to show up right above this line right here, and I circled those areas. So here we were exceeding 2 right before that 7% or so dip in May. Here we were exceeding it here noticeably, especially here, but 2 back-to-back penetrations of 2 right before that 20% dip. And then here we are. You got to go further back though. So again, feel free to think of these as false signals. I think I do. But so we had the 2% gap, just a little bit, maybe maybe a 2% retracement. In here, it just kind of we just had some sideways, probably choppy action. We had a few red bars in there. But that was 3 months or so before the 10% correction here in January 2018. Touched it almost a few times, got close, but not the big sell signal here. So certainly not perfect. You can say 3 of the last 5 times this signaled pain was due the market, and here we are today at all-time highs. Again, another more reasons to be concerned, folks. What we're doing every single day with this market is looking at it objectively. Of course, we look at the fundamentals and macro conditions, which I talk about a lot on the written blog. But we want to chart these things too and look for patterns and similarities that give us a feel for what's going on in terms of the underlying character or the underlying positioning of all market players in the aggregate. And right now, we have some things to definitely be paying attention to. Okay, last one, and I apologize for the busyness of this chart, but I'll make sense of it here. Talk a lot here about shorting and short interest. When you short something, you borrow shares, you sell them, you have to buy those shares back, and you hope that the item or the security that you borrowed goes way down in price so you can pay a lower price, deliver the shares, and pocket the difference. So this tracks short interest on SPY, which is the exchange traded fund or ETF that tracks the S&P 500 index. Largest, most liquid ETF in the market. This blue line is the short interest, the number of shares shorted on SPY. So notice what I've been noticing, and I've done videos in the past on this here, but right here we got to an extremely low, I think a record low in terms of short interest on SPY, and this was late 2017, right at the beginning of 2018. 28 days later, the market rolled over and we had a 10.2% correction. Here we are bottoming, not at as low a spot, but we did bottom and turn higher 35 days before that whopping 20% correction that we had the fourth quarter of last year. You may recall I did a video when the short interest was way up here, right here near the bottom. And I said, folks, we have huge short interest in the market. We have hugely negative sentiment back in there. So we had a lot of cash on the sidelines, and we had folks very exposed, thinking that this market was going to continue to go lower. So the point that I made in that video was we just get a tiny bit of good news and you are going to see this market rocket higher. The good news was a much more conciliatory tone from the White House on trade, which quite frankly was the source of the bad news, that be U.S.-China trade relations that forced this worst December since 1931. So again, got some good news here. Now remember, the shorts have to buy those shares back. So if the market takes off with them short, they could lose everything. They could lose a mountain of money because stocks can just keep going up and up and up. So what'll happen is when they get scared out of the market, they cover those shorts. So my point in that video was when we see that short coverage come in, it's probably going to exacerbate any upside that we got. And sure enough, we got some huge upside. So then short interest has come all the way back down, not quite back to these levels back here, but pretty doggone low. And it got there and bottomed 15 days before we had this 7% move down in May, or 6.76. And then here we are today at least as low, if not a little lower level than we were here. And we're at all-time highs, folks. So we should absolutely expect at some point, now short interest could go lower, but it's going to have to resolve itself. These levels are awfully low. There suggests there's a lot of optimism about this market. And when shorts actually engage, remember, they are selling stocks at that point, expecting them to go lower. So that selling of stocks, of course, can exacerbate the downside. And then you've got people who are making a lot of money up in here. And some of them are shorter term traders, of course. In fact, a lot of them are. So they're going to come up, they're going to ride this thing up, and then they're going to set their stop losses at certain levels. We break down below those levels, the shorts come in, stops get triggered, then you have rising short interest and triggered stop losses. So that could precipitate something, along the lines of a double-digit correction. Now, do we wonder at this stage, with the industrial complex globally really rolling over, with the Fed feeling like they need to jump in right now, which should tell us that there's a lot more going on than just a strong labor market. My concern would be that under these conditions, and there doesn't seem to be any let up on the trade war rhetoric. There, it may be getting softer with China, but boy, it's beginning to heat up with the rest of the world. I can just see this morphing into something ugly, and I just wonder how long the consumer will hold up if indeed we do see a declining stock market and we don't see improvement in some of these other areas that ultimately could bleed into the consumer sector, change that sentiment in a hurry. And so I'm telling you folks that in my view and all the things that I see right now, I think a correction is due or a dip is due in the market. And it could take a while. Could be a month from now, could be 3 months from now. I'll be very surprised if we don't see something pretty noticeable to the downside in terms of volatility between now and the end of the year. I've been surprised before and I could be surprised again. My concern is that the underlying conditions and what that might precipitate, which is why we are having a discussion about how to hedge portfolios with clients right now. So if you haven't been watching your inbox the last couple of weeks, I want you to go back, look for an email directly from me titled Options Hedge. And I want you to read that and watch that video. If you don't see anything, just stay tuned and be watching over the course of the next few days. I'll leave it there. Thank you as always for watching and listening, and stay tuned.